Ladies and gentlemen, good day and welcome to Aptus Value Housing Finance India Limited Q2 and FY26 earnings conference call hosted by Dolat Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mona Khetan from Dolat Capital. Thank you, and over to you, ma'am.
Thank you, Danish. Good morning, everyone, and welcome to the earnings conference call of Aptus Value Housing Finance India Limited to discuss its Q2 and H1 FY26 performance. We have with us the senior management from Aptus to share industry and business updates. I would now like to hand over to Mr. Anandan for his opening comments, post which we can open the floor for Q&A. Over to you, sir.
Thank you, Mona. Good morning, ladies and gentlemen. I am Anandan, Executive Chairman of the company. I warmly welcome you all to the earnings call to discuss our performance for the quarter and half year ended September 25, Q2 FY26. Before we begin, I hope all of you had a wonderful Diwali. Wishing you continued happiness, health, and prosperity in the year ahead. And before I start the detailed presentation, just one small update. Mr. Balaji could not join the call today due to a certain medical emergency in his family. Just convey his apologies and look forward to interacting with you in the next few days. I am today joined by Mr. C.T. Manoharan, AD, Chief Business Officer, Sanjay Mittal, CFO. And during the year, as you know, we broadened our shareholder base and further diversified institutional shareholding, enhancing the market liquidity and participation from long-term investors. With a vision to reach 20,000 crores AUM in the medium term, we aim to build on the current momentum and sustain 25% plus growth driven by our expanding footprint and consistent execution. As we have consistently shared in our earlier interactions, our strategy continues to revolve around four key pillars. Yeah, and I'm pleased to note that we have seen good progress across each initiative. The following are the key pillars that we've been sort of discussing, in the recent times. One, in terms of expansion of expansion beyond southern markets. As you know, we are steadily expanding our presence in Maharashtra and Odisha, where our early experience has been encouraging. Both states witnessed healthy traction in disbursements and customer acquisition, supported by continuous branch expansion model. As of 31st October 25, the total branch count in these two states stood at 15, including 4 new branches added during the month. Second initiative is our digital enablement and process efficiency. Our new loan origination system, what we call Jiva, has gradually stabilized across the branches. It is already enabling stronger process control, improved data accuracy, and better monitoring. In parallel, we are witnessing noticeable process improvements across legal, credit, sales, collection, contributing to smoother execution and enhanced efficiency. The other key initiative that we are working is a diversified product and customer base. Our balanced growth across housing and small business loans continue to support portfolio stability and earning consistency. As you know, we started to a diverse base of self-employed customers across Tier 3 and 4 towns, which helps sustain steady demand and predict service quality across market cycles. And the other major initiative of the focus on productivity and operational excellence, we remain focused on enhancing the productivity and operational efficiency. Data-driven insights and systems-led improvements are enabling teams to deliver high output, improve service quality, and cost efficiency, strengthening the foundation for scalable growth. With that, I would now like to move on to the key operating and financial parameters. Business and growth. Our disbursements in Q2 26 grew 24% Q on Q to 963 crores. Our disbursements in H1 over on a year-on-year basis to grow about 8%. The disbursements growth of 23% YoY on Q2 FY26 was largely influenced by our calibrated conscious increase in the minimum login ticket size of over rupees 7 lakhs per proposal, along with apart from some temporary weather-related disruptions. The AUM growth, however, is at 22% YoY and 4% QoQ. Profitability and efficiency. We have the profitability and efficiency. During the quarter, the total income grew by about 27% YoY to 534 crores. The NIM rose 27% to 399 crores into a growth of 27%. Our OpEx as a percentage of AUM remains stable at 2.7% for the quarter. The OpEx, both as a percentage of assets and cost-to-income ratio, on both the parameters, we are one of the best in the industry. And our credit cost, our operating profit growth came in at about 27% YoY to about 312 crores. The credit cost was increased to 50 basis points in H1, mainly due to certain accounting policy change, because we have now decided to go for a 100% technical write-off of outstanding beyond 500 days. Earlier, we were following a practice of 100% write-off beyond 2 years. That 2 years has now been reduced to 500 days. And profit of growth, as I mentioned a while ago, to about 24% to about 227 crores, translating to an ROA and ROE of 7.9% and 20%, which I'm sure all of you must have noticed is one of the best in the industry. And we are able to consistently improve our financial metrics quarter on quarter. The profit hence for FY26 rose 26% to about 446 crores. On the asset quality side, our GNPA has gone up slightly by about 6 basis points to about 1.55%, and our net NPA is at 1.17. We have strengthened our collection organization in this regard at the state level and also at the SO level, whereby lot more closer follow-up of our collections is being pursued with an intent to reduce the GNPA further down. On the funding side, the cost of borrowing improved to about 8.42 from 8.62, about 20 basis points less on Q-on-Q basis. In fact, our latest borrowing, which was done, was around about 7.9%. The borrowing mix comprises of about 56% from banks, 13% on a consolidated basis, and about 20% for the HFC alone is from NSB, about 18.7% NCD, and the balance is through securitization. As part of our ongoing focus on liability diversification, we have executed a direct assignment transaction about 170 crores during the quarter and about 300 crores for the half year. We maintain a strong liquidity of about 1,700 crores, including about 1,100 crores of undrawn bank sanctions. Now, with these remarks, I open the floor for Q&A session. Thank you.
Thank you, sir. Ladies and gentlemen, we'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use headset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Rajiv Mehta from Yes Securities. Please go ahead, sir.
Hi, good morning. Congrats on good collections performance, and thank you for taking my question. Sir, first is on disbursement and collections. Can you tell us how the disbursement and collections performed in September and October? Just wanted to check what is the latest monthly business run rate since we've been adding distribution, and also what is the latest collection trend, because in Q2 it seems that your early stage collections were better. So just wanted to understand what was the exit trend in September and how October is playing both in terms of disbursement and collection.
Actually, as you must have noticed that in Q1, we actually Q2 has grown over Q1 by about 24%, and this increase done, this is despite the fact in this period we have taken a call to not to log in any loan of a size lower than rupees 7 lakhs with a specific purpose to keeping in mind that we would want to maintain clear distance from a microfinance kind of business. And also going forward, we would want to really keep moving our profile and quality of the customers better. So we have taken a call not to really log in any, actually from 1st of July, we stopped, taking in any proposals of less than 7 lakhs. But despite this issue, we've seen a good growth in disbursements in the second quarter. That we are able to see that in the month of October as well, which gives us the confidence to be able to maintain a reasonably good Q-on-Q growth in the third quarter onwards. As far as the collections are concerned, as I briefly mentioned that, we have really strengthened our organization, not as we feel the collection, because we have really we have taken 2 steps, where up to 12 EMIs, it will be the responsibility of the branch team, branch manager and the sales officer who generated the proposal, to be totally in charge of the first 12 months collection. And after 12 months, it moves on to the collection stream. And within the collection teams, up to 180 days, anything outstanding between 90 to 180 days, it moves into the collection team. And after 180 days, in addition to the collection team, there is an independent legal recovery team also will take over. And for this, we have clearly identified the job responsibility at the branch level, at the cluster level, state level. And we have strengthened our middle management, staff at the state level, very strongly. And this has really started seeing very positive impact on our collections improvement. And that should really help us moving forward. That should help us really improve on collections, not only improve collections, but even reducing the NPA.
Okay. So this below 7 lakh, ticket size portfolio which you stopped logging from July 1st, what is the current proportion of this portfolio in the current overall AUM? And have you seen worsening of asset quality trend in that particular segment and portfolio, and which is why you've stopped logging that in? Because overall asset quality is fine, seems to be fine, but you're saying that, that below 7 lakh portfolio is something that you will not focus on incrementally. So just wanted to understand what is the underlying asset quality trend in that particular portfolio and what is the proportion in the overall?
I just want to highlight this decision has been taken not really based on the portfolio performance or in terms of lower collections or higher NPA. No. I know our credit, our NPA percentage or the collection efficiency is reasonably good in that. So it is not really taken for so much on the consideration of the higher or difficult collections or higher NPA. No. But it is really taken with a very clear purpose of with an objective of moving to a better quality, a better profile customers. Where in fact we have now started, very actively, very closely, in our PD, in our credit bureau data analysis, in the account aggregated data analysis, with the purpose of clearly improving the profile of our customers itself. In fact, we have done the data scrubbing, and that basis, we have done the data scrubbing for the entire portfolio, including the 7 lakhs, including around less than 7 lakhs. And that is satisfactory. So in other words, I just want to differentiate between the two. Clearly, we would want to move away, because what happens is that now you propose, earlier we used to log in proposals like 5 lakhs, 6 lakhs, which to some extent started coming closer to the microfinance type of customer base profile. So our intention to move on to 7 lakhs plus more with an objective of improving the profile of our customers going forward, rather than exact, any particular issue in terms of delinquency or NPA.
Clear, sir. Thank you so much. I've got more questions. I'll come back. Yeah.
Thank you, sir. Our next question comes from the line of Renish from ICICI Bank. Please go ahead.
Yeah, hi, sir. Just two things from my side. One on the credit cost front, right? So, till last quarter, we always used to maintain on guidance at 50 basis points.
It's not clear.
Is it better now, sir?
Not really. Can you speak a bit closer to the mic?
Just give me a minute. Is it better now?
Yes. Slightly better.
Yeah. Okay. So just two things. So one on the credit cost front, right? So, till last quarter, we used to guide credit cost between 30 to 40 basis points. Now, what has changed?
Sorry, it's not very clear. Do you want to try again and maybe we'll take the next
Yeah,
one?
Sure.
Thank you. Our next question comes from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, sir. Thanks for taking the question. So firstly, on growth side, so now eventually we have seen AUM growth being at almost 22%. And the asking run rate for what you have been guiding in terms of more than 25% it really calls for maybe the uptick on the disbursement side on an average to say when you look at it like almost like 30-40% higher than where we are in Q2. So firstly, maybe what is leading to that? Maybe the overall repayment run rate has been quite volatile over the past couple of quarters. It has gone up again in this quarter. And how will we push towards the disbursements to get to more than 25% AUM growth run rate? Yeah.
Actually, Kunal, we are very confident of pursuing this 25% run rate in the area. In fact, despite the fact our disbursements are not, disbursement lower in the first half, for a couple of reasons, like I've explained in terms of the cut off in our loan proposal, size of the loan, 7 lakhs and above, and also certain weather rainfall related issues in certain pockets, certain clusters that we operate. This has, and also to some extent the new Jiva software that we've introduced has taken a bit of time to settle down, which has now completely come on board. This gives us the confidence to really, and on top of it, this year we are planning to add 40 branches. Of that, 22 branches has been added, largely in the second quarter. So with all these actions in terms of our new branches that is coming to being, and B is that in terms of completely settle down our Jiva software, and 3 in terms of the impact of this initial impact of the sales staff at the branch level to get adjusted proposals of only 7 lakhs and above. That got settled down already. We have introduced it from July 26, July 1st. It got now settled down. And we are seeing, the greater fully acceptance level coming in from October, this month onwards. So this makes us to believe that we can definitely look for, in fact, our experience in the month of October is validates some of these assumptions and gives us the confidence that we will be able to, move very comfortably move towards 20 plus growth. Of course, despite the challenges around.
Sure. And volatility in repayment rates over past, maybe this quarter it was higher. So have we seen a slightly higher BT out?
So on the BT out, basically, actually, no, not really. Because, our BT continues to be around 7% kind of thing, 7.5. Of that, as we did say earlier, around 5% is really the customers pay money out of their own source. Either, either of a redemption out of a local sheets or really the money that they've saved from their businesses, that kind of thing. In fact, we have also checked this data after 6 months when they went back to the credit bureau and checked whether these customers have taken loans from anyone else, and they have not taken. Almost 98% of them, they have not taken the loan. So, in other words, that seems to be money genuinely coming from the customer own source themselves. So, that means only about around 2.5% is really the actual BT going to either the banks, particularly smaller banks, or some of the slightly higher level housing companies, mainly based on the in terms of maybe slightly better interest rates and things like that. But there's no major change or behavioral change apart from on this 2.5%.
Yeah. So when you look at it earlier, you used to say 2.5% through the cycle. This quarter it was 7.5. But when you do the analysis, maybe most of them have not taken the loans from others. So it's more like a prepayment which has happened.
No, again I'm saying the 7.5%, of that 5% came from their own source. It has not gone to any other financier, including the bank. So what
Yeah.
has been loan transfer is only 2.5%.
This number is annualized. It's not for the quarter.
Got that. Sure. Yeah. Got it.
We do a detailed analysis of the 7.5% in terms of what money came from the own sources and what is the extent of loan transfer to other banks or the housing companies.
Got it.
When the
Perfect.
customer change their own source, we keep track of it for 6 months.
And
At the end of
lastly-
6 months, we also check the credit bureau.
Got it. And lastly, this write-offs of 13 odd crores. So you mentioned like it's the change in the policy which has already provided, because when you look at it, it's like really hitting the P&L. So not able to get the context in terms of like was that provisioning also done, because this 13 odd crores number seems to be on the higher side and credit cost is also high. And how should we look at it? Maybe are we largely done with the write-offs, or this could be an ongoing process and credit cost can continue to be relatively on the higher side? Because you mentioned like you have moved from 2 years to maybe 500 odd days. So to that extent, maybe can this continue for next few quarters?
No. Actually, you are right. Our credit cost has moved up from 20 basis points to 50 basis points. If you look at our ROE 3, there in the presentation, for the half year, our credit cost has moved from 0.2 to 0.5. So there is an increase in the credit cost to that extent. Now, this increase of 30 basis points is mainly arising out of a conscious call, a specific decision taken by the company. Earlier, we are going for what we call the technical write-off, meaning any outstanding beyond 2 years, we are writing off 100%. Instead of 2 years, now we have reduced it to 500 days. So in other words, any outstanding beyond 500 days, it will be written off 100%. So that has really
But the provisioning was not done because... No, the question is, I understand that. The only question was, on the provisioning side, it is still having the impact on P&L. So were this not entirely provided loans?
No, it is not. On the provision side, as the initial sheet we have given, there is on the provision side, depending upon your stage 1, stage 2, NPA accounts, whatever, for example, in stage 3, whatever 25% provision that we be providing consistently, we are providing, and stage 2 also the provision data is given. And on top of the provision, we continue to carry our management out here of around 48 to 50 crores. That's also the number is given. So it is not that credit cost comprising of both the provision element and the write-off element.
Got it. Yeah. Thanks a lot, sir.
What comes in the debit of the P&L account, credit cost comprising of provision as well as the normal provision as well as the write-off, both.
To add you, 500 days generally we have provided 25%. Now we are stepping it up to 100%. So that is I think this is specifically...
Perfect. Yeah, that's right.
Also, let me also add one more point. In our, we considering our product mix, particularly slightly non-home loan slightly, as a percentage going up. And also our pricing per se provides for, we have consciously provided 0.5% as the credit cost in our pricing of the products. Only thing in the past, it was not, we were only actually getting a charge of 25 to 30 basis points. But then, to be on the conservative side, we said we will, take it up to 50. That is one of the reasons why we have consciously gone for this decision of writing off beyond 500 days rather than waiting for 2 years.
Got it. Thanks a lot and all the best, sir.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit the question to one question per participant. Should you have a follow-up question, please rejoin the queue. Our next question comes from the line of Nitesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir, and good morning. Sir, our company is doing quite well on asset quality and profitability, but on growth, disbursement growth numbers are weaker than I think what it should be. So, in that context, sir, if you can share some data that what percentage of your disbursements in the past has been coming from below 7 lakh rupees loan, so that we can adjust, we can see that what is the impact of this change in our disbursements, and if you can give some data on how is the disbursement run rate in October, which also can give us confidence that we should be able to show improvement in growth in coming quarters.
Actually, I'll go by as far as the growth is concerned, disbursement is concerned. Let's look at this way. Q1 of FY25 and Q1 of FY26, if we see, there is a good growth. There's a growth of about 14%. Q1 of 25 and Q1 of 26. When you come to, let's say, Q2 of 25 and, Q2 of, 26, the growth is it's only about 3%. Now, when you come to the half year of 25, half year of 26, the growth in disbursements about 8%. If you see the growth in 26, Q2 over Q1, it is around 34%. So in other words, our Q2 26 has grown by 24% over Q1 of 26. Not only that, we are seeing that improvement continuing in the month of October. I won't be able to give you the specific numbers of October, but we are very confident for a very good growth rate, reasonably good growth in the third quarter, which after looking at the October numbers, and there will be good Q1Q growth in Q3 over Q2 of 26. But again, let me tell you, this is despite the fact, effective July 26, we have taken the call of, not taking the proposals of less than 7 lakhs. Earlier, prior to that, whether, let's say, in the current year first quarter, or the numbers in the previous year, FY25, includes our disbursements, where we are taking the proposal even of the size of 5 lakhs, 6 lakhs, 7 lakhs business. So to answer the question, yeah.
So, what is the percentage of such disbursements in the previous quarters? If you can quantify that.
No, I don't have the number. I can quantify them and share it out offline. But the point is that, as I mentioned, this call is being taken primarily looking at, we want to be, clearly away from the microfinance kind of profile of customer. We all know that microfinance loans are sizes around 3 lakhs, kind of thing. But we would want to be very clearly away from it. Yes, is that we also, in fact, when we've done the scrubbing of all our existing customer data, even what we have done in the past of less than 7 lakhs, our repayment profile wise, it is normal as the other profile, other customers, 7 lakhs plus. But despite that, we have taken this conscious call of not pursuing that, because going forward, we want to work on improving our customer profiles, our loan profiles better.
Sure. And second question is on credit cost. If you can quantify the impact of one-off write-off policy change in this quarter.
No, it's not one-off. This is a policy call, the accounting, there's this policy call we have taken. So going forward, we will be charging off Anything above 1 year, after 500 days, we'll be charging us. Yeah.
But sir, in this quarter, the impact would be much higher because suddenly the loans which were in the bracket of 500 to 2 years, on that we have taken an accelerated charge. That flow through will not be at the same quantum from the next quarter, right? So
yeah, fair enough. Yeah, it's true. But we'll follow a consistent accounting policy.
sure. So from the next quarter onward, then we should again expect the credit cost to come down because there is a slightly higher credit cost because this is the first time we have charged a pool of loans. But from next quarter, do you expect credit cost to come down from Q2 or this is now the new run rate?
So I would not want to really, give a specific comment on that. But you are saying, logically speaking, it should come down. Yes.
Sure. Sure. That's it from my side, sir. Thank you. Thank you.
Yeah.
Thank you, sir. Our next question comes from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So a couple of questions. So you clearly mentioned that we are one of the best in OpEx to assets and operational efficiency. Also, we will be relying more on productivity going forward. So could you just throw some light on branch productivity aspects, wherein if you can just put out a number on loan files per officer and how that has been improving? Of course, you have dealt with tech initiatives, but more so on the human capital or physical aspects part which can contribute to productivity, which will help us maintain this kind of strong OpEx to assets number.
Actually, our OpEx as a percentage of AUM, which is around 2.7%, is not there just for this year or this quarter. It's been there like that last almost 10 years. Okay. So in other words, there is very consistently, despite the fact, while the ratio remains at around 2.7%, but our investments in branches, our investment in IT has been going up, and to support the growth in business and manage our risk better. But despite that, we are able to maintain our OpEx as a percentage of AUM or our cost to income ratio broadly in this region, mainly through the consistent improvement in productivity, not only at the field level by the sales officer, but even other than because of the customer-facing jobs, as you know, it includes sales, it includes collections, it includes the credit, legal, and also the HO staff. So in other words, we look for, while definitely the file productivity of the sales officer is tracked on a month-on basis, and on a daily basis, or weekly basis, monthly basis. Equally, we are also able to bring in productivity in all our support functions and the HO functions also. Similarly, every aspect of our operating costs also we see our costs are really monitored and tracked for getting a better output or better results for the money that we spend. So in other words, this productivity that way is all pervasive, and as a culture we've been normally it's all known that we follow maybe slightly proven way of working, a culture that we follow that helps us. And coming back on the sales productivity, currently while today our login productivity is around 3 to 3.1 file per sales staff at the branch level, there are some branches which are doing higher, some sales officers are doing higher, some branches they are doing lower, and it is average what is given. But we are working in that area of improving that from the current level.
Okay, sir. So second question is on ticket size. So because you mentioned you have done data scrubbing and also you evaluated and have decided to move and shift towards slightly higher ticket size. So going forward, have you put a threshold kind of thing, wherein your average ticket size will be retained or will revolve around those levels, say 9 lakhs or 8.5, 9 lakhs, which has been the case for now over 2 years. So any thresholds on ticket size beyond which you will not like to exceed and maintain your core focus?
No, actually it is like this. Today my average login ticket size is about 10 lakhs and our average sanction disbursement size is about 9 lakhs. And, and as you know, being affordable housing finance, we really cut normally our loans, we normally keep it less than 30 lakhs. But the range that we operate is really now is about from let's say 7 lakhs to around largely 15, 16 lakhs. Another range. But then if there are a good customer profile, we will go, but not beyond 30. So in other words, we have really taken a conscious call because given the market that we address in terms of Tier 2, Tier 3, Tier 4 cities, and given the profile of the customers largely self-employed, we have taken this in terms of, we would not look at loans generally beyond, we can, as you know, there is nothing like legally or RBI NSB guidelines doesn't prohibit us to do even much higher value. But we have, and the company taken a call that we don't want to do any loan beyond, let's say, 30 lakhs. But then less than 30 lakhs also we have chosen, by and large we'll be confident, very happy, between 10 to 20 lakhs. Okay, the 10 lakhs, now we are at 7. Progressively, our plan is really increase it by 1 lakh average ticket size per year. So if it is 10 lakhs login today, we may look at 11 lakhs next year and maybe 12 lakhs year after. That's the way we go. And this also reflects partly the inflation that takes place in the construction costs. So it is not really taking a higher risk in that sense.
Yes, very elaborate answers, sir. Very helpful. Thank you so much and all the best.
Thank you. Our next question comes from the line of Shailesh L. Kanani from Centrum Broking. Please go ahead.
Yeah, good morning. Thanks for the opportunity. So my first question was with respect to our stopping of disbursement below 7 lakh ticket size. Now I appreciate the fact that we are doing it to stay away from MFI customers. But in the past, our commentary has been that there is not much overlap, no overlap as such with MFI customers. And to be honest, our asset quality has been better vis-a-vis peers, right? So why this move when the disbursements are kind of little bit lagging than our earlier assumptions? So if you can just elaborate something on that front, sir.
So as I mentioned, this decision to log in only 7 lakhs plus transaction. It is in our view, it is the right decision for the company going forward. Yes, it has met with a short-term impact of our disbursements growth slightly, got impacted in the, let's say, second quarter, maybe second half as well. But then that is, very temporary according to us. In fact, now we started seeing our entire team has, down the line has accepted that, and now in October, we now got to, everybody now got adjusted to, got reconciled to, started working. Okay, hereafter going forward, this company is going to do only 7 lakhs of amount. Now the point in the 7 lakhs is more than the point in 7 lakhs. The objective of this decision is really long term. The objective is progressively we want to, move towards a better category, better quality credit-wise customers, and they will have, this will also, they will have more, credit bureau data, better credit bureau data, and also they will have better, account aggregated data, and also Because, for things like, for example, even PD, from from a manual discussion of PD, now we are planning to go for an audio video PD, which means that the customer should be able to communicate, talk, and things like that. And so in other words, the decision of the company is to keep moving towards better quality customers. But at the same time, these quality customers located in Tier 3, Tier 4 are largely self-employed.
So, thanks for that elaborate answer. So basically, there is no early signs of stress in the book. Is that a right assumption?
No, it's not. Actually, we have done, we have done the customer scrubbing of all our 1,70,000 customers, 30,000 customers. 55% of our customers, they don't have any additional loan, other than Aptus. 20% of the customers, they have one more loan in addition to the Aptus loan. Then we see only, post-fund, in fact, we have, actually, our customers where some interest rate with the MFA customers is only around 1.5%. So, and when we looked at the same thing when we looked at in terms of the loan size wise also, there is no significant, we have not seen, even on our day-to-day operations, collections, NPA and all, we don't see any significant difference in less than 7 lakhs. But despite that, I think I've repeated several times on this, credit, the delinquency is not very expensive, at least for us. We are wanting to move to a better category, better class of customers.
That's
the
very helpful.
transaction size, because we are also realizing that this is a home loan of 15 years, effective tenor of 10 to 11 years. We don't want to get into 5 lakhs, 6 lakhs, where your EMI will be less, your collection cost will be more, and will keep growing.
That's very helpful. So thanks a lot. So just a related question, as you mentioned in the earlier question as well, as we move towards little higher ATS and then we are not doing anything less than 7 lakhs, does it impact our blended yields in any case going ahead 1 year, 2 year down the line?
So actually, as I mentioned, we are not significantly increasing our ATS. Our intent is really, as I told you, last year our login was average 9 lakhs. This year our average login is 10 lakhs. Next year we are planning for 11 lakhs. Year after, 12 lakhs. This is really a normal increase, some of it normal increase, partly on account of inflation also. So in other words, there is no significant, our ATS is not going to move up from a 10 lakhs to 15 lakhs to 20 lakhs to 25 lakhs. No, we are not working on that.
So that part I understood. I just was wondering, as we stop below 7 lakhs, does it impact the blended yield in case we are getting higher yields in that category?
No.
So I was just trying to understand that.
No, absolutely no, because we actually, okay. Thanks for asking the question, but we charge the same rate for all the customers.
Yeah. That's helpful.
Based on the loan size,
Yeah. Okay. And sir, a last question from my side. If you can share the disbursement figure, an absolute figure for month of September, if not for October, but the quarter gone by, if you can share the number.
I don't want to get into this monthly, weekly, please. Yeah.
Okay, sir. Thanks a lot and best of luck, sir.
Thank you. Ladies and gentlemen, a humble request to everyone that the management will be able to address questions from all the participants in the conference. Kindly please limit the question to one question per participant. Should you have a follow-up question, please rejoin the queue. Our next question comes from the line of Samir Bhais from Diamond Asia. Please go ahead.
Yeah, hi. Thank you for the opportunity. First of all, congratulations, sir, for a stable set of numbers in a difficult environment, especially given what's happening with respect to the weather changes, etc. I had a quick question on from our medium-term goal of 25,000 crores of balance sheet in terms of loan assets. Just wanted to get your sense on how confident is one to reach this number given the current macro setup, or would you require a meaningful pickup in macro to kind of reach there? Or given with current setup, current productivity numbers, current branch addition plans, we remain confident of hitting that over the medium term? That's one. And secondly, as the prior participant Nidesh asked on the credit cost impact due to policy change. One is obviously the flow part, and secondly, it's the stock part on the current set of assets. Is it fair to assume that the impact on this quarter was mainly due to the stock impact on the policy change, and flow impact incrementally should be lower? That's it. That's all from my side. Thank you.
So I'll answer the second one part first. Yeah, the credit cost in the current period, increased largely on account of this accounting policy change. Okay. So, whether because of that the credit cost will come down, while we consistently will follow the accounting policy of writing off dues beyond, 100 days, the policy will follow. But, and we are confident of maintaining our collections, improving our collections, working on our NPAs to reduce it further. But I won't be able to specifically say, because, if it is 50 basis points, suppose it becomes 52 basis points or 55 basis points, other 5 basis points variation. I don't want a question to be asked. Because saying that you said 50 basis points, now it has gone to 55. It can be 50, it can be 45, it can be lower also. But the point is that, as I mentioned again, we are working, look at our NIM, look at our ROA, look at our ROE. So whereas my credit cost goes up by 5%, 5 basis points, and my pricing also provides, 50 basis points. So, let's not get into, too much on this. But I'd like to tell you that it won't be substantially different. And if at all, maybe there could be some on the reduction only, on the lower side only. And we won't really, but it may not contribute very significant reduction because we've decided to practice policy for, in future as well. So, let's not look at it as a one-time one, and it's not going to happen next year. And because of that, our credit cost will come down, let's say, from 50 to 30. No, I won't be able to commit to that.
Sure. And secondly, on growth, yeah.
On the growth again, I think we have discussed. Again, we are looking at this. We have 25,000 crores area in the medium term as our immediate goal, and we are really strengthening the organization in every aspect, whether at the field level, at the cluster level, at the HO level, and in every function, be it in sales, marketing, and every other function. Not only that, the emerging compliance requirements, also we are investing in our functions, whether in internal audit, risk management, or compliance functions. So the entire organization is geared up, and we have really done substantial investment, to be mentally prepared, organization prepared for this 25,000 crores at the medium term. And in fact, again, based on our estimated year-end area, if you really work out, if you really grow at a rate of about 25% CAGR in the next 3 years, we will cross even 25,000. It will come down around 26,000 crores also. Okay, but I will say that there could be, while we are very confident of achieving this goal, but there could be a variation in terms of one quarter maybe earlier, one quarter maybe late. That's about it.
Great, sir. Thank you and all the best.
Thank you. Our next question comes from the line of Kushan Parikh from Morgan Stanley. Please go ahead.
Thanks for taking my questions. Just a couple of questions. One is I just wanted to check on the incremental yields, and given that we are getting a benefit on the borrowing cost side, have we taken or are we looking to take any PLR cuts on our incremental yields? Also, wanted to understand on the growth side, this quarter, I mean, we laid out that the BT outs have not really changed from the long-term trends. However, I mean, when we just look at on a quarter-on-quarter basis, the runoff in the portfolio has increased from 373 odd crores to 463 crores. I mean, is the 463 crore odd number the normal run rate that we should take going forward as well in terms of the runoff from the portfolio? Yeah, these are my two questions.
Our growth actually, really, our AUM growth largely depends on our disbursements. We don't see any concern, at least as of now. We have not seen this concern in the last, out of 16 years, we have not seen this kind of, concern. BT concern in the last, 5 years, 10 years. We are in the current year or the foreseeable future, because the BT rundown it really seems to be in a reasonable range, and we are not seeing any excessive flow or variation in that. So our challenge in our loan book growth, AUM growth, is more in terms of our ability to enhance the disbursements, rather than get excessively worried about the BT. Because having said that, we very closely monitor the BT, and we get into the reason, logic in terms of why did this BT happen and where the funding came from. Is it and why it is because of additional loan somebody offered? Is it because lower rate somebody is offered? I mean, we do an exhaustive analysis for every BT. But so our, at least at this point in time and for, the immediate future, we don't see the BT as a major issue for us. What we see major challenge for us is really how do we really, to attain our goals, how do we really and work on the increasing the disbursement, including through improvement, smaller improvements in our ATS.
Understood, sir. And on the incremental yields?
Incremental yields. Actually, okay. Actually, we are not seeing any pressure, issue, compulsion, regulatory advisory issues, on our lending rates. So, whether it is not, by and large, we do about 15.5 for the home loan. We do for LAP around 17.5 for the LAP. We do around 21% for the SME. And we are, we don't see much of an issue there. And as you have seen that we are able to maintain a consistently, higher than industry level realization. Of course, partly helped by our product mix coming through our subsidiary company, the SME business, where our lending rate is 21 as opposed to the home loan of 15.5. But having said that, actually in the last Q2, we did make some slight optimization. That earlier we were charging in the home loan 15.5. For the home extension and renovation, we are charging 17.5. That we have aligned it, and they are transferred in home loan given by NSB. So we have aligned that also into home loan rate of 15.5. But the share of the extension are, those is only smaller. It's about 3-4%, about 5-6%. So that way it doesn't impact our, yield, but then optically, we are able to present ourselves better on the field. Same way in terms of SME, it was earlier 22, we have optimized it 21, but then that again, optically it goes well with the, we understand the regulators and things like that. It's a minor tweaking that we have done. This has not affected our yield. In fact, our yield, for the quarter, for the half year, is good, very good. In fact, much higher, you must have noticed, much higher than any of our competitors.
Fair enough. So, just one last more longer term question. We've had two big changes in terms of moving from 7 lakh ticket size and also the new write-off policy that we have. Given that is not going to impact yields or credit costs in a very significant way, is it fair to assume that we still are aiming to maintain or improve our 20% ROE target?
We are very confident of not maintaining, improving the 20% ROE. We are very confident.
Yeah. Understood. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, we request you please kindly limit your question to one question per participant. The next question comes from the line of Gaurav Singhal from WFM Asia. Please go ahead.
Yeah, hi. Thanks for taking my question. I think most of the questions have been answered, but maybe one more. So like in this direct assignment income, we have a pretty big jump in this quarter, and also we started this recently. So maybe can you share our philosophy on direct assignment? I'm guessing it also helps with the principal business criteria, but what's the philosophy and quantum?
Look, basically on the direct assignment, we've started, while most of the companies, listed companies in particular in the housing finance space and the NBFC space, they are doing the direct assignment for several years now. At least 5-6 years if you can recall. But we are really consciously bit conservative on that. But then looking at it in a broader sense in terms of going forward from our ALM point of view, from the additional and newer source of funding, and also from the point of view of the principal business criteria as applicable to HL company. We thought it is our interest to look at the direct assignment as well. And so going forward, we will have a part of our portfolio, going and, being offered under this direct assignment. But having said that, in the current quarter, we have done a direct assignment of about 190 crores. And in the first quarter, we have done about 130 crores. Cumulatively, we have done about 320 crores of direct assignment, which on our loan book of 11,700 crores comes to about 3%. Okay. So going forward, we may look at while we have the board authorization to go direct assignment up to 10%, but of the loan book, we may look at around 6 to 7%, not beyond that.
Okay, thank you.
Thank you, sir. Ladies and gentlemen, due to time constraint, that was the last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you, sir.
Thank you. Thank you, Mona, for organizing this conference call. I would like to pay my sincere gratitude to all the analysts and investor friends who have taken time out to listen to us today. Please feel free to contact us in case you have any further queries. And, Balaji and Amit will be there to be in touch with you. Thank you.
Thank you, sir. On behalf of Dolat Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.